All right. So, welcome everyone. And today our topic is to talk to you about income taxes. Income taxes is governed by the principles as laid out in Ind AS 12. And essentially, what we are talking about, when you think of income taxes from an accounting standard perspective, is largely deferred taxes, right? So, because the current tax, for which we have a detailed paper, which is mostly driven by the Indian Income Tax Act 1961, that is something which gives you the full guidance law, as to what requires to be done while you determine or compute your current taxes, right? And as we commonly experience that the accountants and the tax authorities, they often do have a difference or a point of view as to when an item is in a way eligible for in a way recognition as an income, right? And hence if it is eligible for recognition as an income, or an item when it is eligible for an expense, you know that is considered in a way differently under the income tax laws, and that is considered differently from an accounting perspective. So because of the differences, the way the items of asset or liability or income or expense are being considered as compared to a tax law versus the accounting regulations, it in a way creates a difference, right? And that is the difference which results into a recognition of an asset or a liability, as the case may be, and that is what is actually, a deferred tax asset or a liability. The other thing which also in a way is relevant from accounting perspective when you look at it vis-a-vis tax is your uncertain tax position, right? So these are essentially two uncertain tax positions are nothing but, let's say, you have taken an income tax in your income tax return, a tax position which is not free from doubt, for example. Okay, and doubt can be at varying degree of possibilities or probabilities, right? It may be, let's say, 95% good, but still is a 5% doubt, right? Or there is a 30% doubt or a 40% doubt, or depending upon your judgment, depending upon the judgment, the past precedent, uniqueness of the situation, etc. And that's called as like a tax position, right? So if a tax position is uncertain, that also in a way results into an accounting assessment as to how you account for it, how do you disclose such tax position. So all of that in a way is being covered through Ind AS 12 or its relevant appendix. And we will try and address in a way this through our conversation, through our understanding, and that's where the whole nuance around income tax, which is a principle, which you need to understand, and it's a very, very important topic. From my perspective, I've seen professionals who actually struggle here, right? Struggle to in a way fully appreciate the concepts. Okay, so you need to just kind of keep things simple in your mind to say, what is it I'm trying to do here? All right. And what we're trying to do here is we are trying to look at your accounting income and related tax outflow. Okay, that should mirror the accounting income, whereas under the income tax law of the country, right, they go by slightly different principles. Okay, not a whole lot different, but at areas where there are different principles, for there are reasons, right? For their reasons. For example, tax authorities would like to tax the moment you have received cash, right? Whereas many times, from an accounting perspective, that is not yet income. It may become an income, but in a future period, right? So the question is that we're trying to find a balance between the accounting income and tax income, right? And since I am drawing up my profit and loss account, my balance sheet based on accounting principles, and if there are divergence between accounting principles and tax principles, and I pay tax basis the tax principles, all right? If you pay tax based on accounting principles, then anyway, there will be no divergence, okay? Because I am paying tax, which is based on tax principles, and I'm doing my books based on accounting principles, it results into a divergence, okay, between the accounting income and tax income, hence related tax expense, okay. So to address that, how much tax expense I need to record in my P&L, accounting P&L, I need to follow the principles which are laid out in Ind AS 12. And essentially your tax expense from Ind AS 12 perspective is a sum total of your current tax, okay, current tax and your deferred tax. So your total income, your total tax expense, okay, your total tax expense of any company, okay, is nothing but a sum total of your current tax and deferred tax, okay. So there are possibilities that your current tax is higher. Current tax is derived from your income tax law, okay, income tax law, which is Income Tax Act 1961, right? The deferred tax is derived with reference to accounting principles, and here basically we have a significant focus here that it is not accounting principles in isolation, all right? You also need to have a fair degree of understanding of how the tax regulations operate, and then in a way marry the two to get to an appropriate answer. And we will try and understand all of this with the help of several examples throughout our discussion. So we will try and cover what is the scope of the standard. Do I need to know Income Tax Act in detail? In a way, answer is somewhere in middle. You don't need to know, you don't need to be an expert in income tax for you to become good at deferred tax accounting, right? For you to become good at deferred tax, you need to understand the differences between accounting and tax, and should be able to, in a way, read both the, in a way, computations, and then you will be able to get it right. What is meant by deferment of taxes? We will try and understand that. What is tax base and why is it important? So, I mean, a concept which we will discuss time and again throughout this is the book base, okay, and tax base, okay, book base and tax base. And what is the meaning of book base and tax base? In a way, what we're trying to say is that what book base is the carrying value of assets and liabilities as per accounting standards, all right, and tax base is your carrying value of assets and liabilities as per tax regulations. So that's the book base and the tax base, and that, in a way, the difference between the two help us assess, is there a deferred tax asset or a liability, whether, and which is called as deductible temporary differences or taxable temporary differences. We will talk about all of that. Temporary differences, timing differences, and permanent differences, right? So temporary difference, something which originates in one period and will reverse in subsequent period, in future period, right? Timing difference used to follow a P&L as a concept. Temporary difference, in a way, follows balance sheet as a concept. And permanent difference is something which will not reverse, right? In a way, let's say you pay an income tax penalty. Now that's an expense, and they will never get a deduction for that. So in a way, that's like, so the way Ind AS 12, in a way, explains something like permanent, and it says there's nothing called permanent. In a way, it says that events or items which do not have tax consequence. consequence, right? In a way, they will not be considered. Similarly, we'll try and understand the deferred tax asset and deferred tax liability, which is the heart of, in a way, this topic, right? What's the deferred tax asset and deferred tax liability? There are certain exceptions, as always, right? There are certain exceptions to recognition, day one recognition on goodwill or on group investments. We will talk about that. And then when you are recording an asset, right, whether that asset is eventually you'll be able to realize or not, and that's an assessment which needs to be done under Ind AS 12, and we will try and talk about that as well. And then the presentation and disclosure. So as you know, that presentation and disclosure is key to IFRS financial statements. So we will talk about that as well. Okay. So now very quickly looking at the examination trends from a CA final perspective, and what we see here that this was examined thrice under the old syllabus, all right. However, under the new syllabus, we don't see this yet to be, in a way, examined. So we lost, as you know, there was nothing in May 2020. So this is yet to be examined, but I think I personally believe that this topic is very important. Okay. And why this topic is important is, again, for your own deep understanding of accounting standard, your deep understanding of financial reporting, right? And as I said, I have often experienced that many professionals do have good understanding of accounting standard, but they do lack the confidence in a way to talk about deferred taxes, okay? To talk about, Ind AS 12. And that's where it's important for you to learn and understand. If you get your foundation right, you will never struggle in terms of at least deep understanding of accounting standard, including Ind AS 12. Okay. And as I said, just try and keep this perspective that deferred tax is, or income tax Ind AS 12 is essentially, we are trying to marry the accounting laws and taxation laws and trying to account for the difference between the accounting laws and taxation laws through certain principles which are laid out in Ind AS 12, in a way which results into a recognition of a deferred tax asset or a deferred tax liability, including relevant presentation and disclosure matter, including understanding of uncertain tax positions. Okay. So that's the key. That's the key, in a way, for us to understand and get it right. And the principle for us to get it right, in a way, relates to our understanding of accounting, which is to say, how do you understand your book base of balance sheet? You look at your tax base of balance sheet, and you then you in a way club the differences between book base and tax base as items which are temporary in nature, and hence they will reverse in foreseeable future. And you look at items which do not have tax consequence, and hence they are not to be considered for the purpose of recognition of deferred tax asset or liabilities, and hence may not have any consequence, right? So we will try and understand all of them in fair degree of detail. So when we think about the scope of Ind AS 12, right, the standards shall be applied in accounting for income taxes, okay? Income taxes. So if you are dealing with indirect taxes, right, like goods and service tax, or a customs tax, or a municipal tax, or there are a number of other taxes, right? Toll tax, for example, right? Now, all of them are outside the scope of Ind AS 12. You kind of deal with them under other accounting standards, or under in a way, general principles of accounting. Ordinarily, a tax, if it is, let's say, paid on in relation to your manufacturing process, it gets clubbed as part of your manufacturing cost. if it is in relation to, so any primary item on which you're paying tax, it gets clubbed as part of that. Only matters which related to generation of income, right, which is eventually being paid like an income tax, that is what is covered and are presented also separately, right, in your financial statement. Other taxes are not presented separately as well. They just get subsumed into the different categories to which they belong, and they are generally being called indirect taxes. Okay, indirect taxes. So all direct taxes are in a way covered as part of Ind AS 12, right, which is your um, Income Tax Act. But for example, if you are doing CSR, right, under the CSR, under the Companies Act, and there's a spend on that, essentially that also is a kind of a tax, right? But that's not income tax, okay? So if you're paying securities transaction tax, right, under the, if you're trading in stock, right, that also not an income tax, and gets again charged to, depending upon the type of the arrangement, that should it get expensed, should it get capitalized as part of your acquisition cost of an investment, and so on and so forth. So for the purpose of this standard, the tax include all domestic and foreign taxes which are based on taxable profits, taxes such as withholding taxes on income which are payable by a subsidiary, associate or joint venture on distribution to the reporting entity. The standard does not deal with the method of accounting for government grants, which is Ind AS 12, the investment tax credits. However, this standard does deal with accounting for temporary differences that may arise from such grants or investment tax credits. So if there are any temporary differences which will result into a tax advantage, of course, then you have to deal with this standard, which is akin to a deferred tax asset or a liability. So what's an investment tax credit? Okay. Essentially, the government do come out with investment tax credit schemes, and this scheme is in a way help, right, to promote investment in certain areas, right, where ordinarily you won't go and invest because of the poor infrastructure, because of poor availability of resources or manpower or so on and so forth. It doesn't fit into your scheme of things. To encourage companies to invest in those areas, government do come out with some of these policies, and not only in India, globally. So benefits received for investment in specific assets. Sorry, just take a pause.